Hello, welcome back. Today, I want to go over some of the lies that we have believed our whole lives about how money works and what we can do about it. So let's get started. Hey, I'm Kristen. I'm an infinite banking practitioner, and I help freedom-minded Canadians take back control over their financial life and live the abundant life that they were designed to live. I was a bookkeeper and project manager for over 20 years, working with a variety of businesses from multinational Fortune 500 companies down to small business. And I woke up to how vulnerable my money was in the traditional banking system when the Canadian government started freezing bank accounts for a cause that they didn't believe in. At the time, I was working as a project manager. I made great money, but I wasn't getting ahead. My family and I felt like all of our cash was slipping through our fingers and we could not get a handle on it. I discovered the infinite banking concept, and it took me a while to find an advisor I could trust. But once I did, I realized that the problem was much bigger, and it blew my mind that this isn't something that we were taught in schools and something that everyone should know. I wanted to shout it from the rooftops. And so at the same time that we were getting set up in our own lives, I started the licensing process and eventually signed on with an agency. And I have since become independent, which means that I don't work with an agency and I am not bound by agency selling rules or anything like that. So I received specialized training with the Nelson Nash Institute. We can see this Becoming Your Own Banker book on the screen here. A fantastic book. I highly encourage you to read it and then reread it a couple more times after that. You can also get the Audible book through Amazon. Fantastic book. Keep reading it. The way that the book was written was to make you come to the conclusions. So it's not telling you what to think. Nelson wrote the book to help you go through the process of realizing what the problems are with your money. Once you realize the problems, then the solution is clear. So let's get into these lies that we have all been taught to believe. First lie is that your money can only do one of two things. It can be saved or it can be spent. We have all grown up with this lie that you have to compartmentalize your money. Either you're putting it into the bank and it's locked up away for some future thing. Usually we're saving for retirement, putting our money away in retirement jail, and we don't see it until we're much, much older. We lock that away for years. Or we spend the money and it's gone forever. That is a lie. The reason that we think this, okay, there's two types of people. We have spenders and we have savers. Spenders are stuck in a cycle of losing interest to fees and outside lenders because they're stuck in a cycle of debt. They're borrowing money, they're spending their future incomes before they receive it, and they're stuck in this perpetual system of constantly borrowing to keep up with a lifestyle that they probably can't afford and then repaying it only to start the cycle all over again. Those people are never going to get ahead. The second type of person is the saver. These are people that are very good, like the Dave Ramsey type people, where they're very good at saving money and they compartmentalize and they save it for specific reasons. Maybe they have a savings account here and a GIC over here, and maybe an RRSP over here and a TFSA. And they save money for different reasons and then they spend it. Trouble is, once they spend it, it's gone forever. They've interrupted whatever growth that have accumulated, and they have to start the process all over again. So again, they're stuck in this cycle of losing their future earnings. Just when they start to take advantage of compounding, they wipe out the account and they have to start again. These people always losing their future income that they could be making off of that money. So here's the thing, what we don't realize is that there is a third group of people, and these are the wealth creators. These are the people that understand that you can save and you can spend simultaneously. And we use leverage and we use OPM, other people's money. The wealthy understand how to do this. They've been doing this for a long, long time. Typically, it's called arbitrage. You may have heard that word before. It basically means that you leverage an asset that you have that's producing income. You leverage that asset to buy another investment that is going to create more of an income. So a good example would be when you buy a house. You get a home equity line of credit, and maybe you use that to purchase a rental property. And now your rental property is earning you another income. And so you've leveraged the equity that you have in your existing house that you live in to purchase a rental property. Same idea. Now, I want to show you the power of compounding because A lot of us get stuck on, oh, it's not a big deal. I'm not making that much money in this account. Anyway, it's not a big deal that I am interrupting it. So I want to show you what happens here if we double the penny every single day for a month. I realize that most of us aren't getting double our investments. That's not realistic. While this is doubling, it's purely just to show you the effect of the compounding interest. Okay. Every day we double this penny. If we notice the first 15 days, not that impressive, right? 1 cent becomes two, two becomes four, and so on. By day 15, that 1 penny has compounded into $163. Now, often we're pulling money out of these accounts that we have saved in once they hit a certain point because now we need that cash. But what if we kept that cash going? What if we kept that into the account for 30 days? Over $5.3 million would be saved in that account if it was doubling every single day. Look at the difference if we pull it just on day 29. We pull it 1 day earlier. The cost is almost $3 million. Lost opportunity. This is how I want you to start thinking about your cash. Every time you move money out of your control, this is what you are losing. You're losing that power of compounding. Obviously, not doubled. This is an extreme example, but I want you to visualize how much cash you could be losing over the period of time. Again, the wealthy, they understand how to save and spend simultaneously. If we look at this slide here, we can see that where the saver is putting cash aside. We see that as the green dots here. This is the savings that's being put aside. They've also learned how to leverage that savings, and so they're borrowing against it. Yes, it takes some time to heat up, okay? But we see that right away they're already better off than that spender was because they're above that zero line. When we start compounding this growth, and remember, every dollar that they're repaying, they have access to that again. Just like if you used a home equity line of credit, every dollar you repay that you have borrowed, you have access to it again. Same idea. So every time this person is buying something and they bring it down into a negative, they're repaying it. By the time they need their next thing, let's say that this is a car, when they go to buy their next car, now they have more cash saved up and they don't need to dip below that zero line. The next time they have even more. I know that this can be hard to wrap your head around. I understand that. I encourage you to watch this video a couple times to get a feel for it. But this is what we're talking about. When I say that you can spend and save simultaneously, I'm talking about saving in something that you own and control and leveraging that. Don't interrupt the growth. You want to leverage, use other people's money, and you want to use that to buy the things that you need to buy in life, self-finance the things that you are financing. That's our biggest need. That is a bigger need than our future retirement, funding the things in our lives. And if we can take control of that, the rest is going to take care of itself, I promise you. Okay, next lie. And this is a heated one. I always get backlash when I start talking about this. Investing in a registered account is going to save you taxes. This is actually false. A registered account will save you taxes today, but it's not saving you taxes down the road. And here's why. When you invest in an RRSP, you are kicking the tax can down the road. It's kind of like going into business with broke cousin Ed from National Lampoons. You're getting into this investment with a business partner that is going to charge you an unknown amount of taxes in the future. They could change the tax rules on you. They control all of the rules in this game. They control how much you can take out, when you can take it out, and they charge you penalties if you go beyond those rules. They're also going to charge you at an unknown tax rate, at an unknown tax bracket in the future. Do we think, based on our current economy and current deficit and budget, do we think that taxes are going to go up or down here in Canada? Do you trust that that is going to work out in your favor in the future? And then finally, when we think about inflation and how much dollars we are going to need in the future to equal the same buying power that we have today, are you going to be living on a lower income in the future? Probably not. RRSPs have their purpose. They are great if you have a really high income year and you need to put money away and bring down your tax liability this year. Fantastic for that. But you also need to have a plan for down the road when you're going to withdraw that. So that is I'm just saying that this is not the be all end all that we were all taught to believe. It's not a one size fits all solution. Yes, you accumulate tax free. Yes, it grows tax free. But when you pull that cash out, there are tax consequences that you have to be aware of. And the biggest problem is we don't know what those will be in the future. So when we use registered accounts, it's kind of like paying the tax instead of on an apple seed. If you're paying tax on the apples when they come off that tree years and years in the future. I don't know about you, but I would much rather pay on the seed, pay the tax that I know I am due now, than trust that the taxes are going to go down in the future, that my liability is going to be less, and what's going to happen with those investments. I would rather pay tax on the seed. So again, the truth is registered accounts, yes, they save you taxes on the growth and on the contributions, but it's only kicking the can down the road and eventually the CRA will get their cut. So let's look at another lie that we have been led to believe. A good average rate of return makes for a safe investment. I don't know how many times I've heard people quote S&P 500, that's the gold standard for what you should be investing in. The truth is that when you invest in any kind of funds in the stock market, you are going to have volatility. The trouble is when stocks go down, they have to go twice as high to get you back up to that baseline that you were at. I want to show this to you. So, if you started with an investment of $100,000, and let's say your investment doubled, you had a 100% rate of return. Amazing. The next year, 50% loss. The year after, another 100% return. The year after that, we lost 50%. Do you see where I'm going with this? Your average rate of return over this 4 years would have been 25%. Now, 25%, that's pretty good. That means that I should have $125,000. The trouble is, that's just the average. When we look at the actual, when you lost 50% and then went back up that 100, you lose the 50% again, that brings you right back down to 100,000. Your investment is not going any higher than 100,000. So you haven't actually made any money. And then the bigger problem is that you still have to pay the fees if you have an advisor. There's generally advisor fees on that. There is a MER fees that you have to pay that all come out of the fund. And so once you start paying the fees and taxes, if it's not a registered account, you still have to pay taxes on the gains. We can sometimes offset it by the losses. But you realize that it's the average rate of return is not the be all end all. Again, that's not the most important number. The actual rate of return is what you want to look at. And you also want to be very, very aware of what the fees are and what the hidden costs are that you're paying inside of that investment or inside of that fund. So the truth is the actual rate of return matters and it has to be weighed against the risk that you're willing to take. Let's look at another lie. Debt with low interest rates is always best. I hear this all the time. People are comparing mortgage rates and they assume that just because an interest rate is maybe 0.2, 0.3% lower than another rate, that it's a much better product. That is not true either. There is a lot more that goes into calculating what is going to save you money than just the interest rate. I want to show you an example here. In this case, we have someone that's buying a car and they have the choice between payments of $250. They have the choice between $215 a month at 8% interest over 7 years or payments of $293 for 10 years at 10% interest for 5 years. Which choice would you make? The second choice, even though it's a higher monthly payment and a higher interest rate, you're paying it off in less time. And so you're saving over $2,000 in interest by choosing the lower term loan here. So the truth is, interest volume is the only number that matters when you're looking at interest paid, not the rate. Oh, this is good. So this is another falsity that we have all been led to believe. And I learned this just in the last couple years. This is a big lie that we have all been led to believe, and it's a doozy. Your cash resides in the bank's. I used to think that when I made a deposit into my bank account, that cash sat in the bank's vault until I was ready to take it out. That is very naive thinking, and that is 1000% not how the banking system works. See, here in Canada, we operate on a fractional reserve system. That means that the bank can take your money and loan it back to you and back to other people at a higher interest rate. Let's look at an example here. So in this case, we have Jim. He's made a $1,000 deposit. The bank now has $1,000 sitting on their ledger. Because we operate on a fractional reserve system, the bank is not obligated to keep that cash on hand. In fact, the bank owes it to their stockholders to make an income. How do they make that income? By putting that money to work. And so the bank is going to borrow to take Jim's money and they're going to lend it out to Lisa. They have to keep a small portion of it on hand, but most of it they can lend out. So they lend $900 to Lisa at 10% interest rate. When she pays that back, she pays $990 back to the bank. The bank has now an excess of $90 in that account. Of that, they're going to give Jim a 1% interest rate. Again, I'm just keeping all the numbers really simple because I know none of us are making 1% in our checking accounts. They pay Jim 10%, so Jim gets $1,010 in his bank account. The bank has made $80 off that transaction. Now, my question to you is, what was the rate of return that the bank made on this transaction? A lot of people come back and they say, well, they made 8% because they made $80 off of that 1,000. The truth is that that would only be true if the bank was using their own money, but they're not using their money. The only money that was theirs in this whole transaction was the $10 that they paid Jim. So the bank has made an 800% rate of return on the $10 that they paid Jim. Now, this isn't a real life example. In real life, they are lending that money out over and over and over again, continuously creating more and more cash in the system. What does that create? Inflation. And so, just by participating in the traditional banking system, we are now contributing to inflation because when we put money into a bank, they can loan it right back to us and to other people at a higher rate, and they can loan out multiples of that money. When we borrow from a bank, same thing. We are borrowing money that actually isn't there. It's not backed by anything. It's just numbers on a ledger. So the truth is that the banks loan your deposits often right back to you, and they earn a very, very high rate of return. So this all brings us right back to what can we do about this? And before I get into the solution, I really want you to think about who has control over your money. How much risk do you have to take in order to make a rate of return on your cash? How much taxes do you have to pay when you do make a rate of return? Who's controlling the access to your accounts? What kind of fees and penalties are you being charged when you want to access your cash? What growth are you interrupting when you want to access your cash? And then finally, I want you to think about all of your credit terms, all of your credit products that you have. I want you to think about who's in control of the terms. What kind of hoops did you have to jump through in order to access those products? Who's in control of the schedule, the repayment plan? Are there account minimums and maximums you must maintain? For example, if you have a mortgage, is there a maximum that you can pay off on that mortgage without paying a penalty? And then finally, what can be taken away from you if you miss a payment or two? I want you to really, really think these questions over. I don't want you to go quickly through this. Because here's the thing. We don't have control, and it's not your fault. We were all taught that we were all taught to go to school, get a good education so you can get a good job, trading your time for money, paying taxes first right off your paycheck, spending as much cash as you can everywhere you look. You're inundated by ads telling you what you should and should not be buying. Everywhere you look, you're inundated by ads that are telling you how much you should be spending, but you're also supposed to save what's left, and you're supposed to chase a great rate of return. And you're supposed to trust governments and big institutions have your best interest at heart. See, the system is designed to keep you in it. It's designed to keep you stuck in a cycle of debt, with taxes eroding your income and punishing your hard work. Inflation is making your dollars worth less, and your registered accounts are only deferring that tax liability, leaving you paying on the fruit rather than the seed. So let's sum up all of these problems into one. And that's that we have one major foundational problem with our money, and that's that someone else is in control. Think about it. You finance everything you buy. Either you are paying interest to someone else or you're giving up the ability to earn interest. Second truth, your money must reside somewhere. Who owns and controls the place where your money is held? And then final money truth, that money must stay in motion in order for it to grow. Banks know this, they do it really, really well. They take your money, they loan it right back out to you, and they make a huge rate of return on it. So it's no wonder that we're all so frustrated with treading water, never getting ahead. Doesn't matter how much money you make because you're not keeping any of it. If we want different results, we must rethink our thinking and we have to do things differently. Let's go back to that wealth creator. So, when we have someone who is storing their money in a place that they own and control, ideally they're getting dividends. They're getting uninterrupted compounding growth. They want guaranteed growth and something that gives them access to it. They learn how to control themselves. They pay themselves first. They buy assets, not liabilities. They use leverage. They know how to use other people's money and they turn liabilities, things that are not making you money, things that are expenses, and they've learned how to take those and turn them into assets. See, the wealthy people, they play by a different set of rules. They know how to save first, put their dollars to work, spend it, and then they pay tax on what is then they only pay tax on what's unavoidable. So if we look at that problem of someone else controlling the banking function in your life, then the solution's clear. We have to take control of that. But how do we do that? Where can we put our money that's going to give us all of these things and that's going to give us that liquidity that banks can use? There's a movie on Netflix called The Bank of Dave. It's a great movie. I encourage you to go watch it. You could go start your own bank, very, very costly to set up. There's all these regulations that you have to do, but there is an easier way. So when we start our own bank, we want to use three really simple steps. We want to capitalize, so we have to fund our bank. We have to put cash there in order to lend it. Step two is we're going to leverage the cash that's there. Keep your money working, and you want to be using someone else's money to finance the things that you need. And then finally, we're going to repay and repeat the whole process all over again. We want to be honest bankers. Just like the bank is making a rate of return, they're making a huge return off of you paying back your loans. We want to do the same thing ourselves. I love doing this in a live presentation because I ask people what the perfect investment would look like if they could design it for themselves. And so I want to kind of go over some of the things that always come up. So they'd want something that's low risk, something with a consistent competitive return, something that's liquid, They'd want guaranteed growth and low volatility. They don't mind getting a slightly lower return if it's going to not play the market and go up and down. They want something that's not registered, not government controlled, and something that's completely private. They want passive cash flow, so they want to be earning something like dividends. They want protection against tragedy and death and creditors, something that's easy to manage. There's no management fees or penalties, something that gives them control. And then they want something that is tax deductible, tax-free growth, and tax-free distribution. They want it to be protected against inflation. And again, they want something that's super, super private. Now, this is the part that blew my mind because I had no idea that this existed. When we're using properly structured participating whole life insurance policies, you get every one of these things except for the tax deductible contributions. So when you put cash into a policy, you're putting it in after tax dollars. So your dollars have already come off your paycheck. You don't get a tax deduction for putting cash in. But once it's in, it's going to grow tax free for the rest of your life. You can access it tax free through leverage. If you start taking cash out, if you start taking the dividends as cash, or if you start canceling part of your policy and cashing it in, then there might be some tax consequences. But when you do this properly in the ways that I teach you to do it, we keep this tax free. The insurance is often a hang up for people. As soon as they hear me start talking about insurance, their brain shuts down and they think, no, insurance is too expensive. And here's the thing. When we think about insurance, most of us are thinking about term insurance. And that acts very much like your car insurance or your house insurance, where when you put in premiums, it's an expense. You pay for a certain amount of time, it's rented coverage. If something happens to you in that set amount of time, then a death benefit may be paid out. If it happens outside of that time, you're SOL. Nothing gets paid out. You've lost all that cash and you get nothing out of it. So you're basically betting against yourself. So you're basically betting against your own demise. You're losing either way. The trouble with term coverage is that it gets more and more expensive every time a term is renewed. So if you buy a 10-year term, yes, it's very, very inexpensive to buy a $5 million policy when you're 20. That same policy, by the time you hit your 50s and 60s, is going to cost you thousands and thousands of dollars every single month just to keep that policy in place. At that point, people cancel those policies because they can no longer afford that premium. And so it's not until later in life that people realize that they still have a need for life insurance. That need does not go away. And so we want something that's permanent and there forever. And so the benefit of having a permanent life insurance in place is that it can never go away. You build equity in it as you make payments. Every year, your equity increases. Every single day, your equity is increasing. The premium is guaranteed. So once it's in place, your premium is not going to increase. That's going to stay level for your whole life. You have cash value that is your equity inside the policy that's guaranteed to grow. And it's an important part of a wealth building or tax planning strategy. Participating policies pay dividends, and those can be used to further grow your cash value and your death benefit. Your cash value, once it's there, it can never be decreased and it can be leveraged. So you have access to this through your whole life. One of my biggest hangups when I first heard about using life insurance was that I didn't want to leave someone else rich if the worst happened to me. And that couldn't be farther from the proof. From that couldn't be farther from the truth. The truth is that no insurance company is going to insure you for more than your human life value. So how much you can quantify that you would be earning through the rest of your life. As you increase your human life value, then your insurance needs increase and we can get more coverage. But no insurance company is going to give you more death benefit than what you would realistically earn. So no one is getting rich. The very, very best you can do is protect your future earnings. Let's go back to that banking scenario. In how many cases in your life are you Jim making deposits and giving it to the bank so that they can lend it out to someone else? In how many cases are you Lisa, where you are borrowing money from the bank? And in how many cases are you both, depositing and borrowing from the same institution? Most of us have a lot of that going on, many, many accounts happening, and we're just participating it because that's normal. That's what we were taught to do. And so there is a better way. What if you could take over that bank's function in your own life? What could that look like? Well, if we're using a properly structured whole life insurance policy with a company that is paying dividends, then as the depositor, you're getting dividends, you're getting guaranteed growth for life. You have this private contract that no one can take away. You get tax-free growth and access through the loans, protection against creditors and death, tax-free death benefit that's paid directly to your beneficiaries, and you have flexible payment options so you can pay that premium in different ways. As a lender, you have risk-free lending because you are lending to yourself. You're borrowing against your future death benefit that is going to be paid out. You have guaranteed repayment upon death, so you don't have to worry if you pass away and there are outstanding policy loans. That's deducted from your death benefit, and your beneficiaries receive the difference. And there is always a difference. There's a pool of cash that you have access to that increases every single day. You get flexible funding on your terms, and you have total control over the repayment schedule. I want you to think about that. You control how much you pay, you control when you pay it, and you even control if you pay back loans. Now, I'm not suggesting that you take out loans and don't repay them, but that can be a part of your retirement strategy. When you have built up a really big death benefit, you can start taking out policy loans as part of your retirement strategy to take them out. When we're leveraging, it stays tax-free, stays under that tax-free umbrella, and you can supplement your retirement income. As a borrower, you have loans that are guaranteed. You don't have to apply for them. You have access to loans immediately, depending on which company we're using. Loans are completely private. They don't show on your credit ratio and they don't show on your credit report and they don't show on a debt ratio. You have competitive interest rates. Again, flexible repayment. You determine when you pay them, how often you pay them, and you can change that at any time. No one is knocking down your door if you lose your job and you can't make payments. You have protection against creditors and death, and that limit again is increasing every single day. So people often ask if using the banking system is causing inflation, what makes insurance companies different? Aren't we doing the same thing, putting money in and lending it back out? Absolutely not. So insurance operates on a very different model than traditional banks, where banks can take your deposits and they can lend out multiples of what is deposited. Life insurance companies have to have capital in order to back all of the money that they have to pay out in death benefits. That means that if there are policy loans, they cannot loan more than the dollars that they have available. So by using a life insurance company in this way to use the infinite banking concept, you are not contributing to inflation. You are taking your dollars out of the system. It's like a quiet rebellion. This little revolution that's going on quietly, people are pulling their money out of the banks and not participating. If just 10% of the population did this, we would see massive shifts in policy. So right now you have two choices. You can either continue going down the road that you're on, where you are losing cash to banks every single day, you're losing more cash to taxes, every dollar you spend is gone from your hands forever. Or you can take the jump, make a call. We'll sit down and we'll discuss your current situation. We'll look at what your future goals are and how we can get you there. The call's free. My advice is free. Worst case scenario, you'll walk away with some ideas of how you can implement this in your future, maybe at a later date if it's not a good time right now. Once we have a personalized plan of what this can look like for you, only then do we go through and apply for life insurance. Life insurance is not a right, it's something that we have to apply for and you have to be approved. There are lots of reasons that people are not approved for life insurance. Usually it's health reasons, sometimes it's financial, sometimes there are other issues that are going on. My job is to fight for you and to make something work for you. So if you are not insurable, we can maybe insure a family member. There's always other solutions we can use. Only once you're ready, then we go ahead with the process and the exciting part starts and we fund your policies and you can start using the infinite banking concept. Now, here's the thing. Just because the goal is to put you in the driver's seat, that does not mean that you are driving the rest of your life alone. I am here to support you the entire way. We want to meet at least yearly so that we can discuss where you are at, any life changes that are happening. If you have an opportunity come up that you're debating how to fund it, if it's a good investment for you to use your policy for, book a call. We'll sit down, we'll discuss it. That's what I'm here for. My job is to support you the entire way. I want you to have that empowerment to be able to take over the banking function in your life. It's an ongoing process. You learn your entire life. And I don't expect you to just relearn everything that you have ever done in your life and take it over right away. So if this is something that you are considering, I encourage you to go ahead and book that call.